The IMF has come out recently and said that the UK will be the fastest growing G7 economy for 2014. This is a bit of an about turn from its predictions last year of 1.5% growth for the UK. We're now talking 2.9, quite a big change. But in fact, unemployment has fallen in the UK and things are looking quite positive for the UK economy. Let's talk a little about inflation, deflation. The spectre of inflation that we were also concerned about a year, 2 years ago, is pretty much gone. Actually, we're not really expecting inflation of any real meaning in the UK or in the US. Deflation is actually a more realistic concern, particularly in Europe, and certainly there are concerns there. In terms of interest rate rises, not really expecting anything like that anytime soon either. Certainly the predictions for interest rate rises have been pushed back further. And in the US, Janet Yellen seems on track to do her Fed exit from QE and then also do rate rises, but probably not till 2015 at the earliest. But of course, in all this, we've got to remember that the IMF could be wrong in their predictions. It's happened before, after all. So let's talk a little bit about markets. And recently, the UK has not been the strongest market in the world. Certainly, we've had relatively flat performance, maybe slightly positive for the US, for Japan and for Europe. But the UK last month was down over 2%, so not so positive. For us, our positioning, well, we maintain long-term exposure to the UK and the US, liking those economies for positive long-term growth and liking the companies in there with strong balance sheets. And when we leave the US and look elsewhere in the world, we maintain broad diversification across many sectors, a little in Europe, a little in Japan. Certainly our frontier markets position, which has done well, is retained in the portfolio, not only for its growth prospects, but also for its diversification in terms of correlation benefits. And with respect to diversification, we maintain our very strong diversification across all asset classes, including assets like infrastructure, zero dividend preference shares, and some structured notes where they offer long-term growth opportunities.